Good afternoon, and thank you for being with us this afternoon. This year it's unusually delayed announcement of Q2 results, largely due to the intervening festival holidays and scheduling challenges that such holidays bring about. Nevertheless, I'm happy to report a very satisfactory outcome of the efforts that the company has taken in its various businesses during the Q2 of the current fiscal. The business conditions continue to remain challenging, and particularly so for capital goods industry and within that space the infrastructure segment. Recognizing that the recovery is not going to be dramatic or rapid, the company has taken several initiatives to improve its efficiency parameters, its delivery capabilities, its skill, its relevance to the customer. These initiatives border on several areas such as operational excellence, digitalization and productivity enhancements, portfolio rationalization, capital efficiency improvements, etc. We do believe that all these initiatives will stand the company in good stead, not only during the current challenging times, but also in better times that we hope to encounter soon. Having said this, let's review how the company has performed on its various parameters in Q2. And before I get into the specifics, the usual disclaimer on forward-looking statements that will be made in the course of this presentation. The highlights of the performance of the company for Q2 is the growth in the order intake by about 11%. All these are in comparison to the Q2 numbers of the previous year. The order book has grown by 4%. Revenue has grown by 8% for the quarter. And the earnings before depreciation, interest and taxation has kept pace with the growth in revenue by growing by 8% as well, thereby protecting the margins. And the recurring profit after tax has smartly moved up by 41%. Starting from the order inflow and the consequent order book position, during the Q2, the company procured orders worth 311 billion rupees, a growth of 11% over the 282 billion rupees of Q2 of the previous year. The order wins of 311 billion rupees on top of the 297 billion that we won during Q1 of the current year takes the tally for the half year to 608 billion rupees, which is a 12% growth over the 542 billion of the previous half year. Much of the orders have come in from the infrastructure segment in the domestic markets and from the hydrocarbon verticals in the international market. The point to note is in Q2, while the international orders was lukewarm, the domestic orders improved smartly by 36%. This is not to conclude that the investment momentum has returned back to the economy, but the fact is ordering and decisions around awards are beginning to kick in the domestic market, and we hope that these would be sustained through the subsequent quarters as well. The composition of the order between domestic and international by and large has remained unchanged between the 2 years in question. We have 2/3 of the orders from domestic markets and 1/3 from international markets. The order book, which has grown by 4% as of 30th September 2016, is at 2,518 billion rupees or 2,51,000 crores, which is higher over the order book as of 30th September of 2015 at 2,426 billion rupees. The share of international orders in this order book is about 29%, very close to the 28% share in the previous year, and that reflects almost 730 billion rupees of orders to be executed from the international contracts. The order book collectively represents over 2 years trailing revenue of the company with the current clock indicates. Where did these orders come from? The 608 billion rupees worth of orders for the half year largely came from infrastructure sector. Half of the orders is from that sector. Hydrocarbon in break from the previous year has joined the party in the current year and have reported a 14% share of this pie. Services part of the business portfolio that we run have done well, and reflecting the revenues that they earn as orders for statistical reasons have a share of 18% of the order pie. Power at 5%, electrical at power at 4%, beg your pardon, electricals at 5% and heavy engineering at 3% actually complete the pie. The consequent order book of 2518 billion rupees as of 30th September has nearly 74% from the infrastructure sector at 1867 billion rupees, hydrocarbon at 202 billion rupees and power at 172 billion rupees are the next larger pieces in this order book to be executed. This in a way reflects where the investments today are happening in both the domestic economy and in the Middle Eastern region where we operate. Coming into the specific performance, the revenue from operations for Q2 at 250 billion rupees is up by 8%, and revenue from operations for the half year is at 468 billion rupees, which is recording a growth of 9% over the half year of the previous year. Of this 250 billion rupees for Q2 and 468 billion rupees for H1, we have 89 billion rupees coming in from international contracts, which represent a 20% growth over the Q2 revenues from international contracts of the previous year, and almost similar 19% growth in the H1. So the growth in the revenues is largely driven by the execution progress that we have achieved in the international contracts that are under execution. In contrast, the growth in revenues from domestic contracts still continue to be muted and face headwinds that require tackling at the ground level. The manufacturing, construction and operating expenses for the Q2 has grown by 9% at 164 billion rupees. And likewise percentage of 8 for the half year at 301 billion rupees. We have in the current Q2 taken in write-off of the unsold inventory of the shipyard, and that reflects an increase in the Q2 numbers of the manufacturing, construction and operating expenses. We've been very efficient with the finance cost. The cost has gone up by 11% at 13.43 billion rupees in Q2 and 26 billion rupees for the half year. The effective cost of borrowing remains at about 7.5% for the group as a whole, which is remarkable considering the conditions in which we operate. The staff costs are up by 3% for the quarter at 34 billion rupees and up by 6% at 68 billion rupees. The company has taken a lot of initiatives to right-size the staffing in its various businesses. I did mention about the digitalization initiative, the productivity enhancement initiatives. All of that boiled down to redundancy of roles, and hence we've been able to shed as a group close to 14,000 jobs over a period of 6 months, ending 30th September. The sales administration expenses have gone up by 6% at 14 billion rupees. And has gone up by 11% at 30 billion rupees for the half year. The increase in sales and administration expenses is largely on account of the provisioning that is required to be made in compliance with the regulatory requirements in the financial services business and the provisioning for expected credit loss that Ind AS, the new accounting standards, have mandated for the parent company's businesses. The total operating expenses for the quarter at 227 billion rupees and for the half year at 426 billion rupees registers a growth of 8% over the expenses of corresponding period in the previous year. Since the growth in operating expenses match that of revenues, the EBITDA margins have been stable at 9.2% for the quarter and up by 0.2% for the half year at 9%. The interest expenses, the depreciation and other income accounts for the rest of the profit charts, and you will find that the other income has moved up smartly by 50%, largely on account of treasury gains that the company was able to achieve in the quarter ended 30th September 2016. The profit hence from operations before exceptional items are up by 41% rupees at 10 billion rupees for the quarter and up by 43% at 16 billion rupees for the half year. As you might know, then the company had indeed announced that the company divested its stake in the insurance business through its subsidiary, L&T General Insurance, and we recorded in the books a gain of 4 billion rupees at quarterly level. And since we didn't have any such exceptional item in Q1 of the current year, the same numbers are carried over as exceptional gain for the half year as well. Consequently, the reported profit after tax is up by 84% at 14 billion rupees for the Q2 and up 71% at half year level at 20 billion rupees as compared to 11 billion of the previous year. Getting into the segment details, the company drives its business through the segments that are infrastructure, power, heavy engineering, electrical automation, hydrocarbon development projects, IT and technology services, financial services, and the residuary segment called others. Looking at the key parameters in each of these segments and starting with the infrastructure segment, which is the largest segment that we run, the net segment revenue for the Q2 is at 113 billion rupees, up by 6%, and for the half year at 203 billion rupees is up by 7%. Of this 113 billion rupees and 203 billion rupees, the share of international contracts which are generating revenue are 37.5 billion rupees for the quarter and 67 billion rupees for the half year. They are up by 17% and 18% respectively. The EBITDA margins for the quarter for the segment is at 7.1%, a decline of 2.2% for the quarter, and at 8%, a decline of 1.1% for the half year. It is important to recognize here that being the project company, and we have spoken about this aspect of our business before, that the quarterly margins are not indicative of what would be the yearly numbers. And we do expect that the margin profile will improve as we go on to the H2 of the current year, and more particularly the Q4 of the current year. The power segment revenues have done well. The jobs under execution both in India and in Bangladesh have progressed smoothly. There is a 30% growth in revenue of the power segment at 17.45 billion rupees for the quarter and at 34.67 billion rupees for the half year. The share of international is pretty significant, 4.69 billion out of 17 billion coming from the international jobs and 8 out of 34 coming from the international jobs for the half year. The EBITDA margins of this business at 3% for the quarter and 4.4% of the half year are indicative of the pricing conditions that are prevalent in the market. It is also equally important to know that while these represent the EPC margin, the margins that are made on manufacturing power equipments are reported as part of share of profits of the company in the joint venture. So the margins of the entire power business, the EPC business, gets reported in two places and accordingly gets divided in terms of reporting. The hydrocarbon segment has turned around. We've had a very difficult 5-6 quarters in the past. We find that the jobs that are currently under executions are moving on nicely. There is a 33% growth in the segment revenue for the Q2 at 24.94 billion rupees and by 16% for the half year at 46.29 billion rupees. More than half of the revenues that we earn are from jobs that are executed in the international markets, and we can find a similar growth in the international revenues, 35% for the quarter and 19% for the half year. On the back of the growth in the sales, the EBITDA margins have improved to 7.1% for half year, for the quarter, and 4.7% for the half year. It is important to bear in mind that the recovery of the business is largely attributable to closeout of the legacy jobs which had carried cost overruns and delayed delivery payouts. Heavy engineering business has also reported good revenue turn. The revenue of the segment is at 7.45 billion rupees for the quarter, which is up by 25%, and at 13.98 billion for the half year is up by 15%. A third of the business comes from international export orders, and that has been the trend, and the current numbers are indicative of that long-term trend. The EBITDA margins have improved to 14.6 for Q2 and 14.7 for half year, largely on the back of closeout of jobs that were in the hydrocarbon segment and process plant segment and nuclear segment of the past year, where there were some liquidated damages for delayed delivery and cost overrun. Having completed those jobs satisfactorily from a client perspective, we have moved on to report margins which are more normalized for the heavy engineering segment going forward. The electrical automation business, the industry is facing headwinds in terms of low industrial growth. The agricultural growth is expected to pick up post-monsoons. We need to wait and watch as to what is the impact of this demonetization initiatives of the government on this business, which has a lot of distribution and supply chain associated network. The revenues are at 10.67 billion for the quarter is down by 5%, and at 19.98 billion is down by 4% as compared to the previous year. The margins, however, have moved up to 15% for the quarter and 11.7% for the half year, largely on the back of improved performance by the electrical standard products business. Because of the lack of investment momentum, the industrial segment and hence the project business of the electrical segment has not been doing well, and this coupled with rather lackluster performance by the metering and product systems have contributed to muted performance of this segment, which otherwise seems promising going forward. IT and technology services are two listed companies, and you would have seen their reports separately announced in the preceding weeks. But for segmental reporting purposes, they are clubbed together to be presented as IT and technology services segment. And the segment revenues have grown by 9% for the quarter and by 12% for the half year. The business is largely international, so you will find that over 90% of the revenues are from international markets. The margins have improved as well for the segment, with a lot of initiatives that the company has taken in terms of the offshore-onshore mix, the operational efficiency, and improving the utilization levels. So the margins for the quarter at 21% and for the half year at 21.4% reflect the improved profitability embedded in this business. Developmental project business represent the Nava power plant that we run, the Toubro port that we own, and the Hyderabad metro, which is under construction. It is important to bear in mind all the toll roads held through IDPL, which is a holding company, is regarded as a joint venture under the new accounting standard, and hence is not consolidated at the segment revenue level or at segment margin level. The profit or loss from those activities are aggregated at a single line item after the profit from operations of our normal business, including subsidiaries, as share of profit from joint ventures. So these numbers do not include the toll revenues or the toll profits. The developmental projects at 9.62 billion for the quarter 2 and 21.16 billion for half year largely represent the revenues earned by the thermal power plant that we operate in Rajpura, Punjab. The margins at 12.6% for the quarter and 11.1% for the half year reflect improved offtake and increasing PLF as well as plant availability factor. Financial services has reported a strong quarter. Financial services complete the complement of services business that our business portfolio has. The revenues at 21.4 billion is up by 13% for the quarter, and at 42.31 billion is up by 15%. The NPAs have been under control at net NPA at 3% of the asset. The disbursements have grown by over 18%, and the margins at 18.5% for the quarter and 16% for the half year reflects the trajectory of ROE improvement that the company is embarked on. We do believe that with increasing focus on areas of businesses to focus on, as well as a rundown of the defocused business, we do expect the overall growth in this business to be profitable. The other segment is a medley of the balance segments. We have realty business, we have shipbuilding business, we have minerals, metals, material handling business, and industrial products business, complementing. They are not connected with each other, but aggregating to 19.43 billion rupees in quarter 2 and 35 billion rupees in half year. Because of the lackluster industrial activity and lack of orders in the shipbuilding business, we do find that the revenues are declining as compared to the revenues of the previous year's Q2 as well as half year. The margins in this business at 6.5% for the Q2 and 3.5% for the half year reports a decline as compared to the 14.6 and 13.3 of the previous years, largely reflecting the write-down in the inventory of the shipyard that I spoke about and the cost overruns that we are encountering in the minerals and metallurgical material handling business, which will improve only when the industrial sector improves its own fortunes. So thank you very much for your attention and open to questions and answers. Thank you.
I did a revenue growth of about 12 to 15% for the financial year and order inflow of 15%. Would you still stick to the guidance?
Yeah, I think if there was any revision, we would have announced it. We do believe we took stock of the situation. We do believe with a half year to go, we are giving it our best shot.
Good afternoon, Rachita from Economic Times.
How are you?
Good, good. I think you can hear me.
Yeah, of course.
So, a couple of questions. Regarding the shipping inventory write-off, can you just give us the details? How much is it? And given the environment right now, do you foresee any such steps might be required in the coming quarters?
We had written off about 100 crores in Q2 and for the half year as a whole about excess of 200 crores. We do think it's one-off and we don't expect any further write-offs on that account. It was important to reflect the actual realizable value of the inventory that we are carrying and hence this step.
Then the other question is regarding the 14,000 people that you said that have been let go. Can you give us a breakup on which businesses are they from? Because you said a lot of them were redundant after digitization. So can you just give us an idea on?
No, I think I did not directly attribute the manpower reduction to digitalization. What we are trying to do at the company level is to businesses which are not in best of shape, we are trying to right size. If we do believe that it is going to take some time for the businesses to get back to normalcy, it is important that we reduce the under recoveries. So to that extent we are redefining the roles, responsibilities and such of those jobs which are hence found to be redundant, we are allowing people to move on.
So
wherever
which businesses?
It's across actually. It's across. I mean, it is such a mixed bag. We've not really gone by business A or business B. We have done something zero based. We have looked at all businesses. But for example, I mentioned about financial services defocusing on certain lines of business. They have let go a lot of people. And it's across. It's not power business we have done. Minerals, metals we have done.
So broadly, if I were to ask you if you can give us a ballpark, how much would it be from financial services and how much would it be from, say, infra?
I'm afraid I don't have the particular statistics that way, but it's suffice to say that it's quite widespread. It's not very heavily concentrated everywhere. It is very important that we have to stay agile and cost competitive, especially in these tough times. So we're looking at even corporate functions. We have looked at all of those functions and we're trying to either merge roles or automate them and review them. Shared service center as a big initiative. We were trying to see how to right size that. Should you necessarily have 10 people doing a job which maybe 5 can do? So it's a zero base effort.
On the orders, if you can just give us a sense, I mean, you said the environment continues to be challenging, but you said that the decision making has improved. What sectors are driving the order book within the infra space, and are there still pockets which are slow and where the offtake has not been very good?
Would you like to hear from the horse's mouth?
Okay, I think we've moved on a scenario where we used to call it cautiously optimistic to being much more cautiously optimistic now, if I can use the word. There's been a lot of positives. We see a lot of green shoots. Certain sectors like roads, railways, the heavy civil sector, especially metros, to a certain extent nuclear. On the power transmission distribution side, we see a lot of positivities. Bulk of the orders that we have won are across these. We see quite a bit of positivity on the hydrocarbon side, though the initial feeling during the beginning of the year was that due to the oil prices drop, we will we'll have certain amount of churning on the hydrocarbon side. We seem to be seeing a lot of positivity there, because I suppose when the prices are down, when they invest, and then they take it forward and capture the boom when it is on. And therefore that theory seems to be working in Middle East, and we seem to be seeing good traction there. One sector which we thought would do much better than what it is right now is the buildings and factory side. Buildings especially, due to the turbulence that is suddenly going on in the IT world in terms of guidance, etc. The hiring as previous is not there, therefore the huge campuses that used to come are slowed down to a certain extent. The residential side is seeing certain amount of drastic slowdown, and I'm afraid this will continue now due to the demonetization. Though per se it's a good step, but I think it will affect the residential sector to a certain large extent. The factories, the Make in India, though it's a very good campaign and we do see some broad momentum there, for it to get effectuated will take some more time. So factories, both minerals and metal, as well as the factories on the building side, which is the cement plants and car factories, etc., are not seeing that kind of momentum. So as a broad, you find certain aspects of the business, plenty of tenders, plenty of green shoots, plenty of action. And some aspects of the business still some tying down. We do see it improving maybe at the end of Q3, Q4. The rest of the side of the company too. So all in all, it's positive. We feel good about it. Yeah.
So this is Shailaja from Beach Newspaper. Two questions. One, I wanted to understand what is the kind of impact that we are talking about from the government's demonetization initiative on the infrastructure sector or the entire construction sector. Whether there is any impact likely on the company's real estate or construction business. And second, in the first quarter, you had spoken about certain orders being deferred, and the benefit of that was expected to come in the second and the third quarter. So are we seeing any of the orders which we recorded in the second quarter coming as a part of those orders?
I'll answer the second part of your question first. There was a major order on the defense side, the artillery guns package to be precise, which we did expect around this quarter because the recommendations are through, and that has not come through in Q2. So hopefully, touch and go Q3, Q4, we should get it. It's a process. It's a deep-rooted process within the defense ministry, and hopefully it should get cleared. Maybe Q3, maybe Q4. One cannot predict this very exactly because the movement of files and many aspects of government to work to clear it. So that's one of the major orders which have got deferred. On the rest of the company side, there are, because today we're dealing predominantly with the government sector. So a week or two of decision making going this side, that side, from our quarterly point of view gets affected. That's why Shankar keeps mentioning in many of his statements that don't look at us as a quarter company, look at us as a full year company or a 6 monthly. It somewhat gives us more breathing time to suck in more of these orders. So having said that, that's the kind of deferment we see. In Middle East, for example, earlier decision making used to be 3 to 4 months, and today the decision making is sometimes 6 to 9 months. And at the year ending in Middle East is January to December to January, whereas our financial year ending is March to April. So they look at things in a different manner. We need to look at things here in a different manner. And these are the two things which sort of, when we report it quarter to quarter, you find some numbers missing. But we are hopeful that by year end many of these things would get made up and we should be broadly on track. In terms of demonetization, firstly and foremostly, as citizens, as people from an organized company which deals predominantly in, which deals only in check payments and direct payments from the client, we believe it's a good step. It's the right thing to happen. I think it has taken the government a lot of courage to have implemented this step, and we welcome this step. At the same time, there are consequences of this action. When denomination of notes that people are used to disappear, and when certain parts of the economy did used to work with cash as a basis of barter, there would be some effect, and I think we have to live through with that. It's a pain that you take through for a short time, but I believe with the kind of action that the government has taken in terms of putting money back into the system, this should get sorted out in maybe a month or 2 months, but it will have some effect. It will take some time to settle down, but we think things should get back by Q4, and therefore one has to brace through this, and one has to go through a certain amount of pain which arises out of it. But all in all, I think it's a good step.
Sir, this is Rahul from Business Line.
Yes, sir.
Two questions. One was that have you been facing any problem as far as the contracts management was concerned? Because contracts management was concerned, because down once you have given, because the whole contract management goes through a series of layers of subcontracting.
Okay.
So they're managing, sometimes it's for labor, it's given cash payments and all that. So are you facing any difficulties on those sides? And secondly, so you mentioned about electrical and automation business facing some amount of issues because of demonetization. Can you expand on that, sir?
As far as the subcontract or labor payment is concerned, does have some effect. We have about, as an organization, maybe 200 to 225 crores of labor payment every month. And this we pay by check or direct cash to our subcontract main account holder or the person, and he has in turn to disburse it to the workers at site. And to a certain extent, this payment is also done by cash. We are not directly involved, but it's done through the subcontractors. In certain cases, due to demonetization, due to lack of availability of cash supply also, I think there are some effects. We have, as an organization, realized this about the time demonetization occurred, because some of our subcontractors did approach us. We had taken special initiatives to see that labor is there at site. They are provided, if required, even food and other facilities at site, so that their immediate needs are taken care of. And at the moment, we even applied for special permissions to see how to debit this money to take care of the situation. There would be some disruptions, but I don't think it would cause any major anxiety yet, because as an organization we have thought through it, and to a large extent we are dealing with it. So it's not I wouldn't put it as a major issue from our side.
As far as electrical is concerned, I was referring in the context of the standard products, which we distribute through dealers, and they are sold at individual unit rate levels, the switchgears. And the markets are in a bit of a freeze, because they need to organize, the dealers, distributors need to organize their own cash cycles. So when I mentioned in the context of electrical, it is more from the supply chain or distribution chain getting affected as compared to the business directly billing on industrial customers.
So your camera makes more noise than our shutter behind.
This is just to take the point of the impact of demonetization forward. Last quarter, the working capital was about 24% of sales. Would there be a downward revision to that in the coming quarters?
Thank you for asking. We've improved. We've actually come down by 1% as compared to where we were. We've been working very hard at it, and all the business teams have been working overtime to get this under control. We have a long way to go. But I hope that a couple of quarters back I said I hope we have peaked in terms of working capital intensity, which we have, and my colleagues have proved me right by bringing it down. So we hope by the time the year ends, we will improve further from here.
Sir, I'm Ravindra from Cogensis. I just wanted to ask you two things. One thing, given the difficult situation right now we are in, would this, you've shed about 14,000 jobs, would that continue in the current quarter? Do you see more jobs being shed? And secondly, you said there's a slowdown in the realty business, and so when do you think you will, what kind of slowdown you are facing, and when do you think your realty business will start showing profits?
This job shedding is not something that is going to be very sequential, quarter on quarter. It's a correction that we do in terms of assessment, and we don't expect this to be the trend. So please don't view it as linear. Insofar as slowdown is concerned, reality sector as a whole is seeing some excess supply, and there is hence a certain resistance to price levels that are being maintained. It is true that land is costly, and that has not gotten any cheaper. So when you put a project on top of an expensive land, then there is resistance to how much you can drop. So discounts to the extent of fluff goes away, but the customers today are finding themselves in a buyer's market. That is generically. Now we all know that a fair bit of unaccounted cash moves to the sector as an outlet for investment. To that extent, there is going to be some rearranging of the orders and the demands. That's from an industry perspective. Insofar as L&T is concerned, Our slowdown in reality is because we are running out of the inventory to sell. The projects that we are executing are coming up in phases. And the earlier quarters we had the inventory that we need to sell on much higher platform as compared to what we have now. This will pick up only when we start launching further phases of these projects. And today some of them are awaiting clearances, approvals, etc. And since we normally do not book until we have all the clearances, and that's the code of conduct that we have in terms of fair business practice. We go through this phase of lull and then again launch. So we're waiting for the next phase to be launched, and we hope.
What's the current inventory level that L&T has, and what's their future plan? You're saying you're waiting for clearance.
See, I think we today have a project in Parel and one in Powai. Powai, what we are doing is in our own property, and Parel is, as you know, along with Omkar. In both the projects, under 10% of the project is what is available. And normally, it's also a part of the selling process that the final 5% will get to be sold when the demand overwhelms. So it's also one way to make sure that we average out the realizations. So nothing unusual about this stock, but pretty low.
So what are your future plans? I mean, when do you think you will start making profits in reality?
No, we are even now making profits. It's not a losing proposal at all. We do expect by Q4 further phases of the projects where we are engaged to get commissioned and launched. And the volume on sales and hence the profits, you will see it in 17-18.
Okay, one question on the hydrocarbon business. I mean, several years ago, I remember you had a large portion of revenues coming internationally from the hydrocarbon business. Today, it's domestically, the domestic markets, which is...
No, it's still international. Domestic, there's hardly anything hydrocarbon.
No, not hydrocarbon. Overall, I'm talking about. In terms of the overall size of L&T, the order book that you talked about is primarily the domestic
You're right.
in the second quarter. So now that with the new US president and oil, we have already seen it going up. I mean, historically, whenever the republics in power, the oil prices go up. So what's your view on, that's one of the key divisions of L&T. So what's your view on the hydrocarbon business going forward? And are you working on any large orders or strategies to grow?
As I said, hydrocarbon business, if you predominantly see, is to do with oil and gas. For us, we are not endowed with so much of oil and gas within the country, but for some gas in the eastern coast, some amount in the western coast, and basically to do with refineries and fertilizer expansion or petrochemical expansion within the country. The largest petrochemical expansion within the country is being done by us, that is for the Reliance J3 program. A few other projects which is on. The fertilizer sector has not taken off in India. So we got to depend on Middle East for the market.
I was actually asking about the international market.
Yeah. So when you go to Middle East, we did last 4 years realize this. Also the fact that domestic was not going well for other reasons. And we did concentrate on Middle East. So we have built up a good resource base and leadership and team in Middle East. When we did this last 2-3 years, as you know, we went through some problems in Middle East. We took a fair amount of contracts from various organizations there. And some of it did not do well for various reasons which has been explained in the past. I think the past is behind us. We have closed out most of the jobs but for 2 which we'll be closing down during the year. And we've gone through the tough times or the contractual issues. Some of the matters that were pending, we have put it up on the clients and we have been able to resolve some of these. And at the moment we have some fairly good orders in Kuwait and Aramco, Saudi Arabia. These contracts are huge contracts, nearly $1 billion both of them. And we have other contracts which we have managed to secure. And the business has turned around and is doing fairly well now. As you would have seen when Shankar projected the projections of hydrocarbon, it did show profitability, and compared to last year it's a fairly big turnaround, I think nearly 400 odd crores. So the business is on its way to revival. And if we can keep up the sustenance, let's say for the next 3-4 quarters, is back to where it ought to be, then it's a question. We see plenty of opportunities in Middle East, especially in Saudi Arabia, to a certain extent in Kuwait, in Oman, and we seem to be fairly well placed in some of the jobs. We seem to be having a good traction. The client seems to be welcoming us back. We have earned our right to demand contracts. And I think as we go forward, we should see plenty of opportunities and plenty of action in this business. We're confident about it, and let's see how it goes.
So I'm retired from Business Standard. Just trying to understand any reason your exceptional gains for standalone is 1905 crores and for consolidated is much less at 402 crores. Any specific reason for the difference?
Yeah, see, you'll have to understand the accounting nuance here. The standalone had 1900 crores because when we sold 10% stake in LT Infotech and L&T Technology Services, we sold the parent company stake and the money came back to the parent. So the gain on those IPOs are embedded in the standalone. Now, when you consolidate the subsidiaries, now it is not regarded as an exceptional gain, or it's not regarded as a gain at all, because it is nothing but rearrangement of ownership between the primary holder and minority interest holders. So the credit goes to minority interest holders and not to the parent company. The 400 crores gain that you see in consolidated financial statement is a result of we selling general insurance business, and that is a subsidiary, and hence when we completely exit, the money comes to L&T consolidated entity together. So the gain is regarded there. So these are 3 different transactions. 2 of them recorded in IFS, individual financial statement. 1 of them recorded in consolidated financial statements.
I thought all of you will be smiling more after looking at your results.
So next week there is a decision OPEC is going to meet and they are likely to come up with a decision on cutting the output. That is definitely good for oil prices. But how do you see that impacting your hydrocarbon business? One. Other thing is India had a small field auctions recently and the results are out. How will that impact? Will you be looking for more business in the domestic market?
I think the OPEC decision which you're talking about is still not a consensus within OPEC. There are some countries agreeing to it and some countries not agreeing to it. OPEC also needs to be worried about what's going to happen in the US today with Mr. Trump having come to power, and especially based on the fact that he wants the US economy to grow back again, what he calls the MAGA slogan, Make America Great Again. There's an emphasis on him to further develop resources within the United States, including the shale oil and other oil and gas business within the United States. Any effect of OPEC cutting the prices and increasing the prices will directly have a bearing on this, because then more money flows into the oil sector, which will help America to put in more resources to develop their own resources. So it's some kind of a delicate balancing. At the end of the day, if oil prices goes up, in one way it's good for the hydrocarbon businesses, because that means more money is available to the oil companies to plow back for more field development or productions, etc., etc. But of course, one needs to worry about what impact it will have on the overall economic situation, because one of the reasons why our economy has been able to perform much better and the GDP growth has been there is also due to the fact that the oil prices have come down, and thereby so much amount of foreign exchange outflows not there towards it, which we have been able to use from our budget deficit and our economic growth point of view. So it's a complex thing to answer. Let's see how things pan out. But as per most of the reports that are available, most of the oil experts that are available, they don't expect the prices to go too far beyond what it is there right now. And that's what they predict for the next year and a half too. And one will take it as it comes after that.
And the domestic small field options?
It's too early to predict. The big names are not shown interest. This is only an exploration. We are not into exploration. We do provide oil field services in terms of subsea pipelines or manifolds, etc. Too early to predict. Let the companies get hold of it. We don't know what kind of exploration it is, where it is, and how it is going to go. We will decide. There would be an opportunity if there's a find, so we will decide based on that.
So this is Anurag from G Business, sir. Sir, what are your expectations for coming monetary policy on 7th of December? And sir, one more thing, sir, you just said that because of this demonetization, there will be an impact in Q3. But don't you think, sir, in this whole process of demonetization, banks will be getting around 8 to 10 lakh crore? And again, this 8 to 8 lakh crore will be again invested in a way for infrastructure development, housing loan and all. So in a Q4 on in next financial year, the demonetization will be a booster for companies like you.
I did say that. I said there will be an immediate impact, but we see long-term gains out of this setup. But rest of the questions, since I am not an expert, I request my colleague to answer that.
Yeah. Now that I have been placed in the position of an expert, let me do that. I think the conditions are ripe for downward revision of interest rates, and that's the expectation of the industry. The growth has been hit because of some of these measures, and inflation is generally been tamed. So if the government wants to counterbalance the signals, at least part of the press and the public opinion makers are of the view that the demonetization is an effort which will slow down the growth in economy. If you want to counterbalance that, then a boost at this time in terms of signaling softer monetary policy will be a good step to take. I do believe that this will be a consultative process and it will not be just the monetary authority alone. It will have some political shades to it is what I believe. But general opinion is it should lead to softer terms. Secondly, in terms of the liquidity, while the banks will be awash with deposits that they did not anticipate, you also need to keep in mind that the infrastructure sector, their lending to the infrastructure sector has been very strained. The NPAs that they carry are relating to those that sector. So for the bank to quickly come in and pump in money would depend on how many new projects are going to come up to them. If it is refinancing opportunities, it is recycling within the same system. If it is going to be incremental opportunity, then it is very important new projects come on board. We hope that the initiatives that the transportation sector is taking in terms of trying to announce combination of projects, be it EPC, be it BOT, be it hybrid annuity, will all find favor in the banking system as and when they come up for financial closure. So I do think Q4 would be a good indicator of how this gets channelized into further credit.
So also in terms of the interest rates, what is the quantum of interest rate cut that you expect in the next couple?
Anything less than 50 basis points would be too token.
So hi, this is Hamsini from Business Standard. Two questions. While your overall order book has seen a decent improvement, whether I look at it sequentially or on a year-on-year basis, one pocket that worries me is infrastructure segment. While there has been a good growth, it's slightly below the other segments. What is your, how are you seeing orders transpire in this segment? And if you could throw a little color on how the pricing pressures are, because I remember a couple of quarters back, you said that the rates are not too competitive for everyone to be in the market.
Okay. I think you've got to look at it in the context of what we are doing in the infrastructure sector. The entire infrastructure sector on a yearly basis, you see, we are booking about 85 to 90,000 crores worth of orders, and the backlog is at about 2,20,000 crores. Now, the rest of we're clumping together the entire infrastructure sector. But when you look at growth here, to keep booking this kind of magnitude of orders, it's not that easy. To have a 10% growth at 5,000 crores is okay, but to have a 10% growth at 1 lakh crores takes some certain amount of effort. We're putting in all the hard work and effort. Also, assuming for most organizations I know, their effective win rate is between 10 to 15%. Ours is sometimes slightly higher at 25-30%. And to keep up with that momentum at that kind of volume does take some ask and take some effort. We've been doing it successfully so far. And therefore I would tend to remain positive about it, but to say that why that number is not growing as fast as something else which is much smaller is, in my view, a little stretch question if you can if I can address that to you and tell you to introspect in your mind as to why do you want to ask such a question to me. But having said that, we will try our best, and if we can push it further, we'll try our best to do that.
On the pricing part, sir.
Okay, the second part of your question was on pricing. It is a competitive world, but I don't think we have seen any remarkable changes in our pricing as we go along. Two things that have changed. Earlier we used to get a fair amount of private sector orders. In fact, in some of our businesses like buildings, for example, 85% of our orders were from private sector. I would say even 90% of our orders were from private sector. Today, buildings, which is predominantly to do with private sector, is nearly 50-50. So when you deal with government, there are certain issues that come up like mobilization advances with interest, you've got to give bank guarantees, you've got to give secure advances, so on and so forth. And the payment terms is rigid at 60 days. Whereas in private sector, if you do fast, you can always go and ask for some faster payment, and they also oblige about it. And they may not be too strict about advance with interest and secure advance. You can give a corporate bond or so on and so forth and get moving with it. So the payment terms, etc., make a difference. And private sector, we used to get a premium, whereas in government sector, you got to be L1. So having said this, because the change in business mix from private to government, there are some amount of stiffening in our working capital and the way we get our cash flow. So that does reflect in some effect on the rates. You cannot say the rates are not reflected, because ultimately rate waters captures everything. Second is, in some of our businesses like hydrocarbon and power transmission distribution, we have become quite a bit Middle East or export earnings. For example, in hydrocarbon it is nearly becoming 80% and power transmission distribution is 50%. The Middle East margins, though it is relatively lower than India in that sense, is a much more secured margin in the sense because there is no inflation there, there is no foreign exchange variation there, and the bank interest rates are also much lower than India. We are not able to give a credit for it in that terms. These add up 3%, inflation plus foreign exchange plus bank rate lower, gives you about 3% advantage. But what we earn is 6% there, maybe what we earn in India is 9%. But the 6 I cannot make it 9% because though I know it's more solid than the 9 that I earn in terms of rupee appreciation or rupee depreciation, I'm not able to give an effect to it, and therefore on an average 9 plus 6 becomes say 8 or something like that, and therefore you tend to see our margins getting depressed to that extent. But the rates are what we used to get before, and it's pretty good from that point of view. As an organization, we're very clear that whatever jobs we do, we got to make money, and we got to do it on time. We got to do it to quality and to the safety standards required, and therefore there's a considerable pressure within us to take good quality jobs. And that's why a lot of effort has gone into getting into EPC jobs, getting into processes, getting into design, getting into engineering, which is what makes us totally different from many other organizations. And that credo helps us to go along, and that's the way we need to go forward.
So these layoffs have been triggered by any reports from any big fours?
I think you're stressing too much on it. I think you've got to capture it in the right spirit. We have 95,000 employees, and what Shankar said it that once in a while we got to look at it linearly to see how to move up the value chain. Certain employees which are very relevant from some point of time are not relevant anymore. The technology is changing. We have put many of our works into shared services. We have brought in backup offices for many of our works. We are moving into a certain amount of automation and digital in some of our common services. The ICIization process has resulted in a different way of looking at the businesses, the verticalization. And there are certain low performers which we were taking along, and we had to take a relook at it because in a competitive world, you got to be agile and smart and move forward like that. And in a 95,000 kind of employee-based organization with nearly 30,000 odd workers, it's not something to be bothered about. It's not a continuous action that we're doing. We took it, and that's the end of it. So let's not make it a matter as if it really concerns. And many of them are old. Many of them are beyond the services that we can do. There are a whole lot of issues involved in it, and it's not something which are as a target running behind. It's done and dusted with.
Just to supplement, it is including the services business, which takes the tally to 1,25,000.
Yeah.
Okay. So the base is much larger.
Much larger.
Financial services and.
Yeah.
Thank you, ladies and gentlemen.